stand, Kathy, on, well, there was no alternative to begin with, and now there seems to be some alternative. Are bonds starting to look attractive, or is still the S&P with its dividend yield looking good too?
Hi, Caroline. Thanks for having me. Yeah, I do think that bonds are starting to look attractive. We like high-grade corporate bonds. We spoke a few weeks or months ago about munis. We still like munis. I really like munis here as well. And when you consider the tax equivalent impact of a muni bond, I think it's very favorable. I love the chart that you put up. We also like dividend paying stocks. The key with the dividend paying stock is if you can get the yield at a very attractive price and you know that the markets will eventually recover, you've got a great opportunity for not only the yield but the growth on the stock side or the equity side.
Kathy, I'm curious here about the potential duration of both the rate hiking cycle as well as whatever this economic cycle that we're in right now, and how you sort of prepare investors for the idea that the easy money, the easy gains that so many people grew accustomed to over the past 10 years or so, give or take a few interruptions, that might be over with permanently.
Yeah, I mean, that's really just about resetting people's thought process and expectations and managing expectations through conversations. We had an incredible bull market in the equity markets for a decade plus. We don't expect to have that same kind of a market with the next 10 years. It will be more muted. So we want to be thoughtful. We also think it's really important to understand that there is a difference between the different companies that are being held in these indices, and that you don't want to just buy the index, but you want to look below the index and really cull out those companies that are going to have forward-looking earnings and be able to grow in this new era.
I want to talk about those earnings, and particularly the foreign exchange headwinds that a lot of these companies, Microsoft, Adobe, have started to mention. Does that make you rethink the way you look at multinationals?
Not really, because I do think that multinationals, they are here for the long term. They are the giants. They have great opportunity to continue to go into these different countries and sell their products. Of course, foreign exchange and dollar strength is always an issue, but overall we're looking for the big picture and will these companies do well? And we know that the foreign exchange changes over time and there will be rotation there as well. We're really trying to go for the big picture on this one.
Talk to us about rotation in and out of dry powder, Kathy. How many people have wanted to be in cash during this turbulence? How much are you trying to persuade to get out of it?
It's interesting. I'm certainly having clients call. A lot of people are really interested to hear what we have to think about what's coming next. But what we've been doing over the last 6+ months is we've been rotating out of companies that are overpriced, high growth companies that are just too expensive, and trying to slowly but surely move clients into more growth at a reasonable price companies or dividend paying companies. And that has definitely worked. And I think it's not too late to still apply that strategy for clients if you haven't done so already. So as we get big runs in the market, take advantage of that and start rotating your portfolio out of things that might not hold up going forward into things that will. Everything's down right now, so it's a great opportunity to make those changes.
For some of your clients who have alternative assets, those outside the traditional world of stocks, bonds, and I guess FX in there here, what's the general advice that you tell them, particularly when I say some of those alternative assets, I'm talking about some of the, I guess, less risky ones out there?
Right. No, that's a great point, Romy, because in terms of crypto, we've been saying that a lot of the digital assets, a lot of this crypto and so forth is very volatile, 3 to 4 times more volatile than the equity markets. And now maybe it's even more so now that we look at the numbers that have come out in the last few weeks even. However, alternative assets is a great space for clients to look at for, just as a diversification and as a buffer in the markets or a hedge. And we've been using real assets as well as private equity. Distressed debt is probably going to become very interesting right now. So yes, if you have the opportunity to look at some alternative investments, I feel and our firm feels that this is a great place to put a portion of your money. I've been putting 20 to 30% of my clients' assets into alternatives.
You mentioned credit. High-grade spreads are now above 500 basis points over treasuries. At what point does that start to also look like a better entry point?
Absolutely. I do think that, again, the idea that we have this higher spread and then going into the tax impact is going to be huge for clients going forward too. I think being able to mitigate taxes for clients is going to be a real addition to their portfolio return. So by looking at yes, maybe corporates are looking more attractive for sure, but when you do the taxable equivalent yield on municipals, that's very attractive right now.